Hey, what's good? It's your boy Matthew Michael, and in today's video, we're here for another Options for Beginners tutorial, followed by another Robinhood walkthrough. In today's video, I'll be going over the process and then actually walking through with you how to buy an option on Robinhood. And I'm not just going to walk through it with you, I'm actually going to buy the option so that you can see how the transaction goes through and all that on Robinhood. And be sure to stick around to the end, because after I buy the contract, I'm going to show you how to sell out of it too, just in case you decide you're happy with your profits or you don't want to be in that position anymore. Because when you buy a contract, it's also important to know how to sell. So yeah, be sure to watch to the end so that you know how to sell out too. But first, I just want to remind you that I am not a financial advisor, and this is not financial advice. I purely make these videos in hopes of helping other people like you. So real fast, before we get into the video, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post new videos every Wednesday and Saturday, so don't miss out. I would absolutely love to have you as part of the family. Also, please be sure to smash the like button. It really helps to grow the family. And if you're interested in getting 2 free stocks, with the second one being valued up to $1,400, please be sure to check out the Webull referral link down below in the description. And when you do this, not only do you get 2 free stocks, but it also helps to support the channel. So for those of you who sign up for Webull using my referral link, thank you. And this introduction is beginning to feel a bit lengthy, so for the sake of time, I'm just going to take my Instagram and I'm going to leave it right here. Do with it as you will, and without further ado, let's get into the video. Alright, so before we hop in Robinhood and purchase a contract, there are some terms we should get familiar with before doing so. And don't worry if you don't quite understand them right away, because it'll begin to make more sense whenever we get in Robinhood. But the first and one of the most crucial things to consider is the expiration date. The expiration date is the date that the contract expires, or the date that the contract is good till, and really after the expiration date or in the final days leading up to it, the contract will lose the value of time. The contract could still have value, but it will lose the value of time. So it's important to know how much time you have until expiration. And this is kind of where stocks and options kind of differ. Whenever you buy a stock, the time is unlimited as long as the company is still a business. But whenever you buy an option, you run the risk of the option expiring worthless. The next thing that's important to look at is whether you want to get a call contract or a put contract. Those are kind of the basic contracts to understand. Those are as simple as it gets. And if you ever hear anyone say anything about naked options, they're talking about buying a call or buying a put. And one thing to understand is when you buy a call, you're buying a call because you think the stock price is going to go up. And when you buy a put, you're buying the put because you expect the stock price to go down. So combining the expiration and the call and put, buying a call for a certain expiration date would be saying, I think it's going to go up by this expiration date. Or buying a put for a certain expiration date would be the same as saying, I think it's going to go down by this expiration date. And the next thing that's important to look at in the process of buying an options contract is going to be the strike price. So kind of going in there with after the expiration date, and whether it's a call or a put, you're going to need to pick a strike price. The strike price is basically the price on which you're betting on. So for instance, with the call, if you had a $40 strike price, a call for a $40 strike price would be saying, I think this stock is going to be above $40 by this date. And basically, once it gets above that $40, the contract is considered in the money because it has passed its threshold. So if the stock is at $41, anything below that $41 is considered in the money, and anything above that $41 is considered out of the money. The next thing to consider is your break even. The break even is the price that you need the option to go in order to break even. So with using that $40 strike example, once the stock is above $40, it's considered in the money. But say you paid $30 for the contract, you would actually need the stock to go up to $40.30 to break even. And I know this may be a little bit hard to process in your head, so I'll be sure to point it out whenever we get in Robinhood. So the next thing that's important to understand when you're buying options is that each options contract represents 100 shares of stock. So when you're buying options, it asks you how many contracts you want. I normally recommend starting off with just one contract. Start out with one, because once the contract is in the money, taking away all the time value and all that, every penny that a stock price moves, an options contract moves a whole dollar. If a stock price moves 10 cents, that's $10. If a stock price moves $1, that's $100. So with options, money moves a lot more drastically. So it may be best to not go too crazy buying a bunch of contracts. The next thing that you need to understand is the fact that there is a bid price and there is an ask price. So what the bid price is, you'll see it when we get in Robinhood. The bid price that shows is basically the highest price anybody is willing to pay for that contract. And usually if you want to get in on the contract right away, you're going to have to bid higher than that bid, because if it's not selling at that price, you're going to have to bid higher anyway, or the value of the contract is going to have to come down. And then the ask price is kind of on the opposite end, which is basically the lowest price someone's willing to sell it for. So here's a special cheat code right here. It may not be the best price at that point in time, but if you know the stock is going to move, it may be in your best interest to just go ahead and put your order price at the ask price so that the order gets filled instantly. And then the next thing is the limit price. A lot of people get confused by the limit price, and this is basically just the highest price you're willing to pay for the contract. So if you put the limit price at the ask price, your order will get filled right away, and it will likely be filled at that price. I don't know why you would do this, but if you put a limit price above the ask price, the option will actually sell for the price in between. So say the ask price is 26 and your limit price is 28, you'll actually end up buying it for $27. The next thing is your open interest. What the open interest is basically how many people are interested in buying that option, how many people are buying options on that stock. And the higher the open interest, the easier the contract's going to be, easier to buy and easier to sell. And the last term before we actually get into buying it on Robinhood is going to be the order summary. So what the order summary is it basically just tells you what you're doing. It may be a good idea to read what the order summary says before you go through with the contract. I'm not going to say too much more than that right now, because you'll see and understand it more whenever we get into Robinhood. Now that we've gone over all that, let's hop in the handy dandy Robinhood and buy an options contract. All right, so here we are in the handy dandy Robinhood, and in order to buy or sell an option, you need to first go to the company that you want to buy or sell the option on. So the company that I'm going to use in this video as an example is going to be Pfizer, and its ticker symbol is PFE. All right, so Pfizer is running on today, and I'm just gonna let y'all know this right now. I don't know whether it's going up or down. I'm just doing this for the video. I'm not doing anything that I think is gonna move too much. So yeah, keep that in mind. But anyways, the way to get to options is you hit trade, then you hit trade options, and then we're getting into the things that we started to talk about. So the first thing that you're gonna do when you get to this screen is you're gonna pick your expiration date. And just for the sake of time, I'm gonna pick the next expiration date, which is the 21st. One thing to look at is for this $39 strike price, it's $20 on this date. But the more time you get, like if I go to September 18th, that $39 strike price is now worth $79. So yeah, that's something to consider. Now I already used strike price, but yeah, one thing to know is these numbers on the side, like this 39, that is the strike price. This 38.50 or this 38.5, that is the strike price. So we talked about whether you want to buy a call or a put. So how you're going to choose whether you want to call or a put is, right now it's on call, but if I clicked on this in the corner where it says put, we're now on puts. As you can see, everything on the puts are red, and that is because the stock price is going up. So you probably know this because you've probably seen the charts, but when you see green, it's gaining value. When you see red, it's losing value. So it looks like puts are losing value right now, so they're probably valued at less. So just for the heck of it, I'm going to get a put for this video. So I'm not trying to put too much in this, just in case something crazy happens. So as you can see, I'm looking at this 37.5 put. It is worth $15. Okay, one thing to look at is the break even. Under the strike price, you can see the break even. So because this is a put, the strike price is $37.50. Once it goes below that, it is considered in the money. But it also has to get to 37.35 for me to break even, and break even is at expiration. So you can still make profit before it actually reaches break even if you still have time on the contract. So yeah, that's where your break even is. This 0.15 on the side, it's 15 cents per share, which turns out to be $15 for the contract. So with the put, where it says the share price is 38.36, everything above that for a put is in the money, because basically the higher you see the contract price is getting, the further in the money it is. And then everything below for a put is out of the money. So that's why they're so cheap. And then with the call, it's the exact opposite. Everything above the strike price for a call is out of the money, and everything below for a call is in the money. So yeah, the further in the money you get, the more value the contract has. But like I said, we're going with the put. We are going with this 37.5 put. And now we have reached another screen before we get in that I can explain some things on. So again, when I was talking about number of contracts and just the power of a contract, as you can see, if I were to get 5 contracts, it would be $75. If I get 1 contract, the total cost is $15. So right here you have your bid and ask, right under where it says limit price. The bid is $14, so that's the highest price anyone's willing to pay for it right now. And the ask is $15, which is the lowest price anyone is willing to sell it for. One thing that people don't normally realize when they first start trading options on Robinhood is that if you click over here, you can actually change your limit price. So if I wanted the limit price to be 0.2, which would be $20, which is actually above the ask price, I could do that. And if I wanted it to be 0.1, which is $10, I could actually do that. So yeah, that's something that's definitely crucial to know when you're picking your price, because you could set a bid at a lower price on a contract that has some time on it that you know will dip down and then go back up in price. So like I said, I'm going to show y'all me actually purchasing this. So yeah, let's go through with it. And I'm just going to go ahead and do it at the ask price so that this order actually goes through. And as you can see, I hit that review, and here we have the order summary, which tells us what we're purchasing this for. The order summary says I am paying $16 for the right to sell 100 shares of PFE for $37 per share by August 21st. If PFE shares aren't $37.50 or lower on August 21st, this will expire worthless. So yeah, be sure to read all the fine print, or just read that little statement if you're new to this and don't understand this. But yeah, I'm going to go through with this. I'm pretty cool with it. And one thing that's important to know, if you don't have 100 shares to sell with a put, you don't actually have to exercise a contract when you're buying a contract. Like if this were a call, you don't have to buy 100 shares. And since this is a put, you don't have to sell 100 shares. You can just flip the contract. That's kind of what I do. And if you have the money to buy 100 shares, that's great. This will actually benefit you more. But yeah, I'm going to submit this order. And it doesn't look like it went through yet. So I'm actually going to wait here with you, or I may fast forward in time until it actually goes through. But yeah, we're going to wait till that goes through. And I actually just canceled the order. I didn't fast forward that just so y'all could see what I'm doing. I'm actually going to try to buy it again. So going back through that same process, the ask price went up another penny. So I think it went up while I was talking to y'all about it. So I'm going to do it at the ask again, and it should be filled right away. And as you can see, did it at the ask, it was filled right away, and have 1 share. Now that we bought our option contract on Robinhood, let's hop back in Robinhood and sell it now. Just a disclaimer, whenever you buy a contract and sell a contract in the same day, just like I'm doing right now, this is considered a day trade, and just be wary. You can only do this 3 times in a 5-day trading period. Otherwise, you will not be able to do it for 3 months straight, 90 days to be exact. So yeah, just be careful of that. It's happened to me and it kind of sucks. And now that I've said all that, let's sell this option. Okay, so in order to sell out, all you have to do is go to that contract, which you can either go to the contract by going to the home screen, or you can go to the stock that you have the option in. And then once you're on the company screen, you can click on the option, which right here. I'm now on the option. I'm down $1 on it. And how I know I'm down, you can see right here on the screen where it says total return. Whenever that's negative, you're in a point where you're losing money on the contract. And whenever that's positive and you sell out for a positive, you have made profit on the contract. That's something I want to let y'all know right now. A lot of people get confused about that. That is where you see your profits. So I'm going to hit trade. I'm going to hit sell. And then I'm gonna do it for one contract. But actually, you already saw me get to this screen. So basically what I would do is I would hit review right here. But let me show you one other way to get to it, just so you know that's not the only way to get to it. So if you go to the company, we're on PFE and we hit trade and we hit trade options and you go to the date that is for. We see by the 37.5 put, there's a +1. If I want to sell out of that, basically all I have to do, instead of being on buy, I would hit sell, and then I would hit the contract, and then I would hit the 1. This brings us to the exact same screen we were on about 20 or 30 seconds ago. So yeah, I'm going to sell at the bid just to get rid of it right away. Or actually, I'm going to try to do it in between to see if I can get it right away. If I don't, I'll just do it at the bid. But yeah, I'm going to try to do it at 16. Just so I only lose $1, but yeah, we'll see. Does not look like that worked. I want to get out of it now just in case something crazy happens, so I'll take a $2 loss on it. Oh no, it actually looks like it sold, so yeah, I lost $1, and that is how you sell out of it if you want to sell out of it. Hopefully you're doing that for profits, but sometimes you have to do it for losses just to preserve your capital. So yeah, so you just learned how to buy an option, how to sell an option, along with the definitions of everything on the transaction screen. If you enjoyed the video or learned anything new, please be sure to smash the like button. It really helps the channel out. Also, if for some reason you haven't already and you're new here, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post new videos every Wednesday and Saturday, and I would absolutely love to have you as part of the family. And last but certainly not least, thank you so much for watching, and peace.